This is Street Smart. I'm Lisa Murphy. According to our next guest, the number of commodity traders leaving banks rose about 10% this year. And one favored destination has been hedge funds. While they might not have the resources of the banks, they also don't have the banks' new regulations. And that can mean more freedom as well as more money, but only if you know what you're doing. Well, joining us now is Peter Henry. He runs senior trader recruiting for Commodity Search Partners. Great to have you, Peter, this Friday on Street Smart. Let's talk a little bit about the cuts we have seen globally throughout this industry. 233,000 cut from global financial services, right, which doesn't include hedge funds.
Sure.
How much of that is coming out of commodity trading? It certainly has been a volatile year.
Yeah, I think that the 230,000 figure is not a massive indicator of how the commodities segments of banks are doing. Within banks, all elements of the institution have to participate in cuts, but proportionally, commodities trading units have not been massively affected. There have been cuts, but typically they've been cutting individuals that...
What about pay? How are commodities? We've talked about bonuses going down. Certainly, when we look at trading, fixed income trading, equity trading, it certainly seems as if bonuses have dropped quite precipitously. Is that true also in commodities?
Sure. So I think that there are several factors that are impacting the payout in banking for commodity traders. Firstly, you've got the impending regulation, specifically the Volcker regulation, which is going to come in and really limit proprietary trading. Proprietary trading is typically where a trader's individual talents can be best monetized. Secondly, you've got banks' desires to defer more compensation over the longer term, over 3 years, paying it out in stock. Typically 20% moving upwards to, in some cases, even 60%. And finally, you've got the fact that while multiple commodity units of banks have generated over $500 million, many multiples of $500 million over the last 12 months, dollars in revenue that is, the rest of the bank's performance have dragged them down. There's not enough of a bonus pot to go around. So we believe that it will be a tricky bonus period for the banks in the coming year. It's not all doom and gloom. They're aware of their situation and they have their moves lined up. But your initial point is correct. Hedge funds is a likely destination, as is physical commodity trading shops.
Let's talk about where they're going. What are they able to earn when they go to a hedge fund?
Well, it's easier for hedge funds to pay them out a clear-cut percentage of P&L.
So it's not salary and bonus?
Sorry, they'll still get a basic salary. However, they'll also earn a clear-cut percentage of P&L, which can, with hedge funds, it can reach 20%, even in excess of 20%. Right now, with the banks, for senior traders, it's not going that far beyond 10% of P&L. The other big advantage is that hedge funds will typically pay you out in cash, so you'll get your money pretty much as soon as you've earned it.
What's the downside? I mean, why not? It sounds pretty. It sounds pretty straightforward. Your pay is much more tied to your own particular performance. So why wouldn't you go to a hedge fund at this point?
Yeah, it's a great question. I think that the infrastructure that a bank provides is exceptional. You have world-class, in most cases, world-class commodity research, which is supporting and justifying the decisions that you're making. You have client flow, which gives you a look at the market. In some cases, you have physical assets that you can play around with as well, not to mention systems, IT, back office, risk and controls. When that infrastructure is pulled away, some of the traders will still be successful in the hedge fund, but a lot of them will fail. It's a very difficult transition.
What are the physical assets that you're talking about?
So a lot of banks will shy away from the physical. There are banks that are wonderfully well-run physical commodity trading businesses, like, for example, Morgan Stanley, who've been trading physical oil for longer than Glencore have been called Glencore. And they will hold assets like storage facilities. They will take stakes in pipeline facilities, and they'll even get involved in financing refineries in return for preferential access to the offtake. That, in turn, creates optionality for the traders to go out and trade around.
I say. All right, Peter, I really appreciate you joining us today, insight into an industry that we otherwise would not be hearing about. Certainly, you're in the flow of the news as it relates to some executive movements. All right, Peter Henry, Commodity Search Partners, joining us today.